In this video, I want to talk about 3 small cap stocks that you may want to look into. Nothing in this video is financial advice. The whole point of this video and this channel actually is to bring you guys new stocks so that you can take them stocks and go and do your own research and decide if they deserve a place in your portfolio. In case you're unfamiliar with what I mean by small cap stocks, these are stocks that have a market capitalization of between $250 million and $2 billion. A market capitalization is referring to the total value of the company's outstanding shares. After small cap stocks, you then have mid cap stocks, which have market capitalizations of between 2 billion and 10 billion. Then you move to large cap stocks, which have market capitalization of above 10 billion. And then eventually you get to mega cap stocks, which are the likes of Tesla, Amazon, and Nvidia, for example. I do want to just quickly say that there is an increased level of risk and volatility associated with small cap stocks. So there is a reason why some investors just won't touch them and don't ever want a small cap position in their portfolio. However, as we know in the world of investing, quite often the more risk, the potential higher the reward can be. So some investors actually do want to take on a little bit more risk and volatility. They do want to include small caps in their portfolio, and they may actually end up seeing better reward because of that. So now let's move on to stock number 1. And this first company behind this first stock is actually an insurance company. But it's not as boring as it sounds, and there's way more to it than just that. It's actually an AI-driven insurance company, and it's called Lemonade. Ticker symbol LMND. And this is really interesting, isn't it? Having this AI buzzword along with this word of insurance, which is quite a traditional, quite a often boring industry. And when these two meet, what happens? And there's good reason why they're trying to use AI in the insurance business. And that is because artificial intelligence actually helps them process claims faster, and it means fewer expenses. What does fewer expenses mean? Well, it means that they can pass that on to the customer, but also they can potentially keep more money as well. But I do want to say they are not yet profitable. And right now they are in their very, very early stages. They only actually went public in July 2020. So it is potentially a little bit more risky right now because 1, they are a small cap company. 2, they are still very, in their very early stages of going public. But there could potentially be a high upside to this investment. So Lemonade right now have a market capitalization of $1.14 billion. And in their Q1 earnings, they reported a pretty strong performance, with revenue actually up from the previous same period the year before. And Lemonade are aiming to achieve a positive net cash flow, meaning more cash coming in than going out, by early 2025, which is actually earlier than what was previously expected. So this could be taken as a pretty bullish sign. They are also planning to actually grow their offerings, and they want to start offering auto insurance by early next year. And of course, when they expand their products, their services that they offer, this could potentially in turn actually boost their growth. So we'll have to keep an eye on that one. So like I said at the beginning of this video, small caps are not for everyone. And some people won't like the particular companies in this video, and some people just won't like small caps in general. But I just want to spend a couple of minutes now speaking about the reasons as to why some investors are so bullish towards Lemonade. Why some investors really like this stock in their portfolio. And number 1 is that it is a category disruptor. There are some companies that come around that completely disrupt an industry as we know it. When I say that, I straight away think of Tesla and the automotive industry, completely disrupting that for what we knew it as before EVs were really a thing. And Lemonade are kind of the same. You know, they're really aiming to disrupt the insurance industry, which, like I said, has been set in stone for a very long time. And they are doing this using artificial intelligence and behavioral economics. They are taking this one step further by using proprietary technology to actually improve efficiencies and profitability. And on top of this, they're doing something very interesting. They are actually allowing their customers to donate leftover money to charities, to causes of their choice. Now, number 2 is that they have a strong brand purpose. Typically speaking, insurance companies are ranked pretty low in their trustworthiness. People do not like insurance companies. They don't trust them. They think they're just after their money. They don't really want to have to interact with them. It's a very slow, a very boring, a very long process. However, Lemonade's mission is to transform that. They want to take insurance from a necessary evil, as they call it, to a societal good. And if they can do that, hats off to them. I think that is a mission worth doing. Number 3 is their value proposition. Lemonade's whole motto is insurance that doesn't suck. They want to make it so that insurance isn't rubbish. Insurance isn't something that you just don't want to sort out. It doesn't suck. And they are actually differentiating themselves by not being an insurance company that actually gains when a claim is denied or delayed. So they take a fixed fee, which just means that the insurance claim can move through quicker. Number 4, investments are seeing this as an early stage opportunity. Growth investors in particular love investing into companies that are early on in their growth trajectory, ones that haven't got to where they're going to get to just yet. You know, this is a very new company. They only went public really recently. They're currently in their stages of expanding their product range, targeting younger customers who are, of course, a little bit more tech savvy, with the whole point that those customers will then stay with Lemonade for their entire lifetime, I suppose, as they make more insurance claims across their life. And also, Lemonade are really looking to improve retention. Number 5, they are focusing on a growth strategy. They are emphasizing growth over profit margins, and they are also heavily investing into customer acquisition. And lastly, people like the leadership team. One of the founders of this company is still the CEO and is still leading this company. And of course, there are benefits that come with a founder-led company. Just take a look at this on Seeking Alpha now. And if you want to try Seeking Alpha for free for 7 days, use the link in the description below. That link will also get you some money off if you do decide to subscribe. So, on Seeking Alpha's homepage, we can see that the rating summary are saying buy, hold, hold. So there seems to be a little bit of a mixed opinion as to whether this is currently a buy or not. But what I want to do is I just want to go over to the stock price, the stock chart. If we expand this to a year to date, you can see Lemonade here in orange has been very volatile. It's been a bit up, down, all over the place. It's underperformed the index, however. It's not been doing very well so far this year. If we expand it out to a 1 year period, again, you can see a similar thing. It has had times where it's been outperforming the index, but over this time period, underperforming the index and then some. 3 years, you can see not been doing too well. However, the people that are very bullish on this position will just be saying about seeing this, that their time has not yet come. They are working on things, they are growing as a company, and at some point, the stock price will match the intrinsic value. Let me know what you think of Lemonade in the comments below. Now, the next stock is a very mixed one. Some investors are bullish on this one, whereas some are screaming avoid. Now, for full transparency, I don't have this position in my portfolio. I'm not looking to add it, and actually I don't have any of the companies in this video in my portfolio. However, it is interesting to research and bring those to you and see what you guys think. The second stock is a company called Navitas Semiconductor Corporation, ticker symbol NVTS. This stock has actually recently hit its 52-week lows. However, it has increased slightly since then, so maybe that time is now behind us. This company develops advanced gallium nitride semiconductors, and these semiconductors are revolutionizing power electronics by making them more efficient, smaller, and less expensive. They are also manufacturing integrated circuits which are used in various products like smartphone chargers, laptops, TVs, data centers, EVs, and renewable energy systems. Navitas is actually viewed as a promising investment by some people due to its leadership in gallium nitride technology, diverse market application, and also they have strong revenue growth. However, there are some risks here. And there definitely are some short-term challenges that this company must overcome. For example, right now they are highly dependent on the Chinese market. And of course, with high interest rates, this could impact their profitability. However, for some people, the long-term outlook is looking very positive. They did relatively well in their Q1 earnings. Revenue was up 73% year on year, but they did miss their EPS estimates. The market cap of this company is smaller than what we've just seen with Lemonade, coming in at $752.54 million. Having a look on Seeking Alpha, we can see the rating summary are coming in quite mixed again, with 2 buys and then a strong sell. And we've also got this warning here saying Navitas is at high risk of performing badly, learn why. And we can click on that and we can see some reasons as to why this may be. Of course, do your own research. You need to base any investments into individual stocks on your own research. But let's just go across to growth. We're seeing revenue growth year over year and A+, revenue forward growth, an A+ as well. And then if we go across to charting, let's see what it's been doing compared to the index. Year to date, not good at all. This is a small cap company. This is quite a small cap company actually, and it's going to be volatile, and the stock is not going to just go up very nicely. It doesn't work like that with these sort of companies. Underperforming the index. 1 year, underperforming the index. 3 years, we can see obviously they only went public quite recently. It had a big peak after the IPO, which tends to happen, and it's been a little bit all over the place ever since. It's hard to say because not many investors want to be putting money into a stock that's doing this, but it's those people that do the research and learn whether this is actually a very good company that will then profit off of a position like this. I'm not saying that it is a good company. I've not done enough research, but it's definitely one worth looking into, and it's very interesting. And of course, it is within the semiconductor industry, which is getting a lot of attention right now. Now, to continue on with the semiconductor theme, let's move on to stock number 3. This is a stock that is also operating within that industry, however, it is doing it slightly differently. This company is ACM Research, ticker symbol ACMR. The market capitalization right now of this company is $1.32 billion. This company is operating within the semiconductor equipment industry, and they're not really the same as the likes of Nvidia or other big names that you've heard when you hear of this word semiconductor. They actually develop and manufacture equipment used in the semiconductor manufacturing process. Specifically, they focus on wafer cleaning technologies. Now, if you don't know what that is and you haven't heard about that, I hadn't before this video either, but go and have a look, go and research it. It's actually quite interesting if you're a bit of a geek like me. They had a pretty good Q1 earnings too, announcing that they had beat revenue estimates and saw a 103% year-over-year increase. However, the stock sold off, didn't it? Of course it did, and this was due to guidance actually being kept the same rather than rising. This whole earnings season has really been down to the guidance given, and even though they did well in the numbers, the guidance remained the same, it was an increase, and the stock sold off. But their revenue target is actually still at $1 billion by 2026, which I think is very optimistic. I think that's a great target to have, and I hope that they can achieve it. Although AMC is an American-based organization, they operate heavily in China. I'm speaking like 99% of their business is coming from the Chinese market. A lot of people will be quite frightened by those statistics because, of course, we can have tension and we can have geopolitical issues between the US and China, and this kind of reliance on the Chinese market could end up quite badly for this company. Beacon Alpha, we have got buy ratings across the board. If we go to growth, we have got many A's coming up on the growth grade and underlying metrics page. Profitability, you can see some interesting figures here. I won't dive into all of this in this video because it will just take too long. You can also with Beacon Alpha see all of their income statements, their balance sheet, cash flow, see how that's going over time, earnings. You know, there's lots to be found on this website. Everything that you need to be able to do research. Now let's look at this. Actually, let's just go to peers for a second. This is showing you other companies that operate within the same industry, and you can see how those companies are performing compared to the company you're looking at. And then if we go to charting, let's take a look. Year to date, you know, they've not done that badly compared to the last two stocks that we've looked at in this video. However, they've still underperformed the index ever so slightly. Massive increase here on the 27th of February. I want to say that that was probably due to earnings coming out back then. And not really much has happened since, going down a little bit. 1 year, actually, really good. 119% basically, which is outperforming the index. 3 year time period, a little bit different here, underperforming the index. 5 years, again, doing really well. But I must hammer home that small caps are more risky, inherently speaking, and they are going to be more volatile. So please be aware of that extra risk, that extra volatility that you take on by investing into these companies. However, there may be an upside to doing that. Personally, I would just research the company. Forget whether it's a mid cap, large cap, small cap stock. Research the company, find out everything that you can about that company. If it's a good company and you want to invest into it, fine. But just be aware that it might come with more volatility, and can you stomach that? Now, as always, let me know what you think about the stocks mentioned in this video, and also let me know whether or not you have any small caps in your own portfolio. As always, until next time, keep investing, keep analyzing, and don't forget to hit that subscribe button.